Okay, so in this video we will be discussing capital structure decisions. This is chapter number 14 from your recommended book. The learning objectives for this topic are: number 1, identify the trade-off that firms must consider when they determine their target capital structure. 2. Distinguish between business risk and financial risk and explain the effects of debt financing has on the firm's expected return and risk. Discuss the analytical framework used when determining the optimal capital structure. And 4. Discuss capital structure theory and use it to explain why firms in different industries tend to have different capital structures. So now we will go through the introduction. What exactly is capital structure? The capital structure that maximizes a firm's stock price is called the optimal capital structure. Basically, your accounting equation is assets is equals to liability plus owner's equity. So every business has to decide what percentage of the assets will be financed through loan and what percentage through owner's equity. This is the capital structure that the business wants to have. So the mix of debt, preferred stock and common equity the firm wants to have is called the target capital structure. This is what the business wants to have. And the optimal capital structure will be that point where the stock price of the firm is maximized. Everybody knows that the main financial goal of a corporation is maximization of shareholder wealth. So even when deciding their capital structure, how are the assets going to be financed, they are still going to think about maximization of a firm's stock price. What combination of debt, preferred stock and common equity should the business have that the stock price is maximized due to it? Now, setting the capital structure is not that easy because the business needs to balance the risk and the return of taking on loan. Using more debt will raise the risk borne by stockholders, and using more debt generally increases the expected return on equity. So there is one positive aspect of using loan and there is one negative aspect of using loan, and the businesses need to strike a balance between these two impacts and try to maximize the stock price. In order to understand this trade-off, we are going to look at an example. So this example is also taken from your book, and it's the first business over here is unleveraged, no debt. You can see that the total assets are 100 and all of these assets are completely financed through equity. So the business has zero debt in this case. Now there are three states of economies: good, expected and bad. The sales, if the economy is good, the sales will be good. So 150 is the predicted sales in that case. But if the economy is normal on average performance, then you expect it to give you a normal sales amount. And if the economy goes bad, then you expect that the sales will be reduced in that case. We are interested in what happens after this. So once you have the operating income, you have the EBIT 45 in good situation, in expected 15 and in bad 0. Because there is no loan, there is no interest payment. So regardless what the economic situation is, you do not have to pay any interest. Interest is 0 in all three cases. Earning before taxes is then 45, 15 and 0, and then you subtract taxes from that. So you get a net income of 27 and if the economy is good. If the state of the economy is expected, then the net income is 9, and if it's bad, then it is 0. Based on this, you have return on equity of 27%, 9% and 0%. How is this return on equity being calculated? The return on equity formula is net income divided by equity. So the net income over here is 27 and the equity over here is 100. So that makes it 27%, and so on in all of the other three cases. So this was scenario number 1. Now in scenario number 2, we have the same business, but now the total assets of 100 are financed 50% through debt and 50% through common equity. So now the combination of financing is different. Again, you have three economies: good, expected, bad. Now your sales are not going to be affected by the way you are going to raise your capital. So till EBIT you can see that the income statement is same. So the good, in case of good state of economy, the EBIT will be 45, in expected it will be 15, and in bad it will be 0. If a business has taken on loan or not taken on loan, that is a financing decision. It will have no impact on the sales of the business. So till operating income, their income statement will remain the same. The difference that arises because of taking on loan is that now you will have to pay interest. So now you are going to pay the interest rate of 10%. And the interest will be paid regardless how the economy performs. So if the economy performs good, you have to pay it. If the economy performs normal, you have to pay it. And if the economy performs bad, even in a situation where you have zero profit, even in that situation you still have to pay your interest. So interest is something that you will have to pay regardless of the economic situation. Due to this, your earning before tax is 40, 10 and negative 5 in the third scenario. Your net income is 24, 6 and negative 5. Now, if you just compare the net income before, the net income before was 27. Now it is 24. The net income before was 9. Now it is 6. And the net income before was 0. Now it is actually negative 5. So if you just compare the net income, you will think that leverage is a very bad thing and you should never take on loan. But now if you look at the return on equity, you can see that where there was a 27% return on equity, now there is a 48% return. Where there was a 9% return, now there is a 12% return. But where there was a 0% return, now there is a negative 10% return. This is the impact of leverage. Leverage has magnified the return on earnings from 27% to 48%, from 9% to 12%. But leverage, if it's going to magnify the earnings, it will also magnify the losses. So even the loss of the business has magnified. First it was 0%, now it is negative 10%. So the positive aspect is that if the economy performs well, the return on equity will be multiplied, it will be magnified. But if the economy performs badly, because interest is something that you will still have to pay, then in that case your losses will also get magnified. So there is increased risk, but there is also increased return. Basically, this magnification is happening because now you're doing something different. First, you were investing 100 rupees, the owner's money. So first the owners were investing 100 rupees and they were getting a return of 27 on this. Now they're just investing 50 rupees. They are just investing 50 rupees and they are taking 50 rupees on loan. But because they are not doing the whole 100 rupees investment themselves, they will have to pay interest. So their net income will reduce from 27 to 24, but still the percentage is actually better. Over here they have invested 50 and they are getting a return of 24. The return in itself is less, but the percentage is more. And in the first scenario they were investing 100 and getting a return of 27, so that was 27%. So the investment amount has reduced now. That's why the earnings will get magnified. Also, interest is tax deductible. Interest has a tax shield, so that also has a positive impact on the earnings of the business. Okay, so I hope now it is clear that how does leverage have both a positive and a negative impact. Moving ahead, there are four primary factors that influence capital structure decisions. Number one is the business risk. Business risk is the riskiness inherent in the firm's operation. If it used no debt, the greater the firm's business risk, the lower its optimal debt ratio. So business risk means you're talking about a business that has zero loan. The risk that is inherent in the type of business that he is doing. For example, if you have a mobile shop and you have opened that mobile shop without taking any loan at all, so the risk that you face is the business risk. If the demand for a mobile phone goes down, that is your business risk. There's a new competitor, then that is a business risk. But the risk is related to your business and not to loan, not to the type of financing you have done. Number two, we have tax position. So a major reason for using debt is that interest is tax deductible, which lowers the effective cost of debt. However, if most of a firm's income is already sheltered from taxes by depreciation tax shields or interest on currently outstanding debt, its tax rate will be low. So another very important point is the tax position. We all know that interest is tax deductible. Third point is financial flexibility, or the ability to raise capital on reasonable terms even under adverse market conditions. So businesses, they always keep a benchmark or a level that in case in the future if they need to raise additional capital, they can raise that capital through debt as well. So they keep a buffer. They will not take the maximum limit, यानी कि वो पूरी लिमिट अपनी एग्जॉस्ट नहीं करेंगे डेट की. They will always keep a margin कि अगर ज़रूरत पड़ गई they can easily use debt as a means of gaining capital. So that means financial flexibility. Last is managerial conservatism or aggressiveness. So some managers are more aggressive than others, hence they are more willing to use debt in an effort to boost profit. So if a business is aggressive and he wants that earnings be magnified, the return on equity, like we saw in the previous example, gets magnified, they will be willing to take on higher levels of debt. But with higher levels of debt, the business will be facing more financial risk, because if interest payments are not paid on time, the business might go bankrupt. So it depends upon the manager itself whether he is conservative or whether he wants to take an aggressive approach. So these 4 points largely determine a firm's target capital structure, but operating conditions can cause its actual capital structure to vary from the target, and you will later on study more reasons that might influence the target capital structure of the business. Now moving ahead, there are two types of risk. Business risk is the riskiness inherent in the firm's operation if it uses no debt. So we have already discussed business risk. Number two, you have financial risk. Financial risk can increase in stockholders' risk over and above the firm's basic business risk, resulting from the use of financial leverage. So you can differentiate the risk that a business has into two categories. One is business risk and the other is financial risk. यानी कि आप एक ऐसे बिज़नेस की पहले बात करें जिसने लोन बिल्कुल भी नहीं लिया हुआ. सो वट एवर इज़ दैट बिजनेस हैज़ विल बी इट्स बिजनेस रिस्क, वो उसके ऑपरेशंस में इनहेरेंट है. बट नाउ थिंक अबाउट द सेम बिजनेस और अब उसने लोन भी ले लिया ना, बिकॉज ही हैज़ टेकन ऑन लोन एज वेल, देयर इज़ द रिस्क ऑफ बैंकरप्सी. यानी कि अगर इंटरेस्ट की पेमेंट्स टाइम पे नहीं दी गई तो बिजनेस बैंकरप्ट हो सकता है. This risk is different from the business risk. This is the financial risk of the business. कि इंटरेस्ट की पेमेंट्स अब टाइमली देना ज़रूरी है. first we will discuss the business risk factors. So what are the factors that can have an impact on the business risk? Number one is demand variability. The more stable the demand of a firm's products, other things held constant, the lower its business risk. जितनी ज़्यादा डिमांड में फ्लक्चुएशन कम होगी, जैसे कि अगर कोई ग्रोसरी स्टोर है जैसे कि इम्तियाज़ है, इट्स डिमांड इज़ नॉट वेरिएबल इवन इन these conditions. Even when the economy is going into recession, his demand is still very stable. So you can say that Imtiaz has less business risk. Then number two is sale price variability. Firms whose products are sold in highly volatile markets are exposed to more business risk. So if the sale price fluctuates a lot, of course that business will have high risk. 3 is input cost variability. If the input cost keeps on fluctuating, again the business will have more risk. Ability to adjust output prices for changes in input prices. So there are some businesses where if the input cost increases, they can pass on that price to the final consumer and increase the output price. So if that is a scenario, if the input cost can easily be converted into output prices, then the business risk will be less in this case. Number 5 is ability to develop new products in a timely, cost-effective manner. So businesses that are in an industry where things become obsolete very quickly, like if they're in the mobile phone sector, new mobile phones keep on coming with new functionalities, then that kind of business will have high business risk. So for them it is necessary that they have to keep on investing in research, they have to keep on coming up with new products, or they will go out of business. Then the 6th point is foreign risk exposure. So foreign risk exposure is there if you are operating internationally. Then of course exchange rate risk will also have an influence, and also even the political stability of that market. For example, if some company is if an international business is coming to Pakistan, they will think about the political situation in Pakistan, whether there are strikes in the country, and what are the power dynamics in the country. Number 7 is the extent to which costs are fixed, which is your operating leverage. If a high percentage of its costs are fixed, then firm will be exposed to a relatively high degree of business risk. This factor is called operating leverage. So जितनी ज़्यादा आपकी fixed costs होंगी, उतनी ज़्यादा आपके operating leverage होगा, और उतना ज़्यादा ही आपका business risk होगा. We will discuss this point in detail in the coming video.